your assessment on what those targets were, and how does that stack up against your own estimates?
Good morning. Thanks for having me. Coming into two sessions, we were expecting above 5% growth target. So this around 5.5 is above our expectation. On the positive side, this suggests that policymakers are still focusing on growth and still would like to see a relatively high growth rate. But at the same time, our view, and I think you heard policymakers making similar statement that this is not going to be an easy task. Takes a lot of effort to get to 5.5. So when we look at more of a bottom-up, different pieces of the economy, whether it's COVID outbreaks, whether it's the housing, whether it's the rising commodity prices and uncertainty about supply chains and so on, and global demand. So we think that indeed 5.5 will be very challenging.
And I guess to your point, indirectly assume, in a lot of ways, there is a multi-pronged approach really to a multifaceted issue here in terms of the challenges here. So let's look at the fiscal side here. The budget, we know what the number is. It looks a little bit conservative on paper. What is your interpretation of the budget?
Right. On the budget, there are many different numbers. I think on surface, when you look at the official on-budget deficit of 2.8%, that looks quite conservative. But if you take into consideration of the budget stabilization fund and how much they can withdraw from that fund this year, and then take into consideration that some of the local government special bond issuance last year wasn't really spent. So if they move from Q4 last year to this year, so that could translate into more resources and funding to be deployed by the government to support economic growth. So when we look at more comprehensively all the different pieces, we came out thinking that the sort of augmented fiscal deficit will expand by 2% of GDP, which would be in line with our projection ahead of the two sessions. So still decent amount of economic support, just given the amount of headwinds the Chinese economies are facing that's needed. But even with a 2 percentage point of a GDP of extra fiscal spending, we're not entirely sure 5.5 would be achieved this year.
And have you done calculations on how much net government bond supply is coming to these markets? Maybe we can make our viewers up. Combine everything for a central, local government, and if you have it also local government special quotas. How much supply is coming to this market this year?
Yeah, this year when we look at the numbers, the issuance is about 7 trillion RMB of bond issuance. And we would caution that there are also other means of financing for infrastructure or public investment. Some of the local government financing vehicles, some of the policy bank bond issuance, which is not added in that 7 trillion, but some of that would be used for public investment as well. That's why we look at what's called augmented fiscal deficit and trying to add those in to look at this holistic picture of the fiscal support.
Now, on the monetary side, if China is using nominal growth as a guide for money supply, and nominal growth at about 5.5% doesn't sound like a lot, is that a hard peg, and should I be worried?
I think if you look at the official statement on monetary policy and credit growth, they have been using this line that money supply and credit growth should be in line with nominal GDP. So 5.5 is a real GDP growth target, and you add on to the GDP deflator to get to a nominal GDP growth. But at the same time, I think this in line in a lot of these official documents is quite a vague statement. Whether it's 2 or 3 percentage points above or below, in historical data, you will see that policymakers still characterize it as in line with nominal GDP growth. And I think if you look at some of the more, sort of white paper or working paper by the PBOC, they also stress that it's not necessarily 1/4 of nominal GDP or even 1 year of nominal GDP. You need to look at the sort of potential growth that type of nominal GDP being the anchor for money supply and TSF growth. So bottom line there, when we look at what the government is saying on lowering interest rate and supporting the economy, we think there's still room for monetary policy to ease, despite the language about credit growth should be in line with nominal GDP growth.